If I made a profit, where did the money go? That has to be the number one question I get asked over and over again by businesses of every size, especially if you can believe it, when that profit or net income means the owner's going to be writing a check to a tax collector of one form or another. Every CPA knows the answer to this question. Why then do so few business owners know the answer? I tried to answer the question. I would direct my client to the statement of cash flows. Some of your cash is tied up in your accounts receivable. In other words, you have loaned some of your cash to your customers. That's what I would say. Some of your cash went to buy fixed assets. Me again. I would have to speak very, very fast in order to get a few words in before the person I was talking to fell asleep on the table. I even tried explaining the balance sheet. Sometimes I would get as far as assets equal liabilities plus equity before the business owner needed a second cup of coffee. I needed a better way. I wanted to bring financial statements to life so they could tell a story of that business. Then I found a piece of software. It helped make those answers so clear and interactive. No more snoring. Take a look. This is Scopit software from Mentor Plus. It starts with the basic financial statement information that everyone is quickly bored by, but you see there's income statement, there's balance sheet, and there's just summary information for each year. We're going to look at 2012. I'm going to go right from the financial statement information to the scorecard. Now I can see the same stuff. I can see the income statement on the left, the balance sheet in the middle, and I can see some key performance indicators on the right-hand side of the screen. This is when the information starts to become more interesting. I'm sitting with an owner across the table from me, and now I have this little scorecard. It doesn't look scary. It's not black and white. It's got some colors, it's got some little buttons. Looks like things might be getting a little bit better. Maybe the coffee isn't necessary. So what we do now is look at what we can tell about this business. We can see that we made net income. You can see it on the income statement. Most business owners, most anybody who works in a business understands positive net income is a good thing. So if you just looked at the income statement, which is typically what most people do, you would probably be absolutely excited and thrilled that you're able to achieve almost $300,000 of positive net income for this business on revenues of $2.5 million. But look at this KPI side of the screen. We only grew revenue over the prior year by 1%, 1.27% to be exact. That's not a very big revenue growth. That may be good in our industry, who knows, but it's not a very big number. But the telling piece of this report is what you see on the next line. Look at our earnings before interest and taxes. We made 23%. So out of every dollar that we sold, we brought back $23 in the prior year. This year we only brought back 14, so we've declined. Something has gone in the wrong direction for the business, and we need to do something to fix that. So let's look at some of the underlying components of that profitability story. We can see that our cost of goods sold increased over the prior year. Part of that was variable, and part of it was what happened in the fixed costs in the business. So our gross profit is lower, so every dollar we sell again, we're getting less return. So that's going to add up and cause us some problems. Our operating costs as a percentage of revenue are increasing. Again, a negative trend that we want to make sure and do something about. But the really big problem for this business is this one, this negative $368,000 of cash flow. There's the mystery. This is the crux of the matter. This is that question that comes up. If I made a profit, and you can see I made a profit, where the heck did the cash go? Here it is. We lost $368,000 in cash. How can that be? Mr. or Mrs. Accountant, you got to be nuts. You got to be doing something wrong. You got to be playing some sort of funky voodoo economics with my money. What happened? Well, here's the story. The income statement is only one part of the business. The other part of that business is what happens in the balance sheet. How are you managing those assets? Are you growing assets and consuming cash to do it? Or are you managing that balance sheet properly? And here's where we can see that story. You can see here that my receivables, the number of days it takes me to collect, the number of days as relative to the amount of sales that we have, has grown in terms of collection. So it used to take me 70 days to collect the sales cash that I generated. Now it takes me 82 days. That means I'm loaning my customers money. You can see that my inventory, I have 907 days of inventory on hand the prior year. Now I have over 1,000 days of inventory. That's consuming cash. And here's another telling statistic. I'm actually paying my vendors faster than I did last year. So I'm sitting around 82 days to collect from my customers, and I'm paying my vendors faster than I did last year, basically on the same terms as my collections. That's going to hurt my cash. So that's where the money went. It went to the balance sheet. It went into this inventory. It went into these days payable. Here's where the software changes the dynamic between me and that owner who might be thinking at this point, okay, it's time for coffee. They still probably don't understand that the cash flow problem is caused by this balance sheet activity. Now I'm going to make it clear to them. What if we could maintain the collection experience of the prior year? Just take that 82 days of collection and cut it down to 70 days. What would that do to our cash flow in this business? Watch what happens now. I enter that number, I make a change, and you can see cash flow improved. I can click on my net change and I can show that owner now. I can show them, not just tell them, not just write it in the highlight it or write it in the margin. I can show an $82,000 improvement by focusing on collection activity and accounts receivable. The balance sheet is sucking away the cash in this business. That's what I've got to do. What if I could undo that change? What if I could do something with inventory? What would that do? What if I could put my inventory days back to last year's experience? What does that do to cash flow? Look at that impact. Now we're starting to have real dollars, $324,000 if I didn't continue to grow my inventory at a greater rate than my sales. It's hurting my business. It's sucking the cash out, and it's causing me to be probably in a lot of pain at this point as a business owner. So this is the kind of insight that you can gain. This is the way that you can make this information finally connect for a business owner. You can bring the cash flow, the income statement, and the balance sheet together with a tool like this that makes the dialogue understandable, interactive, and hopefully far more interesting than the same dialogue that you've had year over year over year with customer after customer after customer without being able to make an impact on that discussion. Now you've got a tool that can do it for you.